All right. Here we are once again, ready to do a little day trading. All right, the struggle is real. As we said out on the little marquee, the little thumbnail, the struggle is real. We're going to try and make a little money today, and we're going to probably try and solve some of the biggest problems, or at least talk about some of the biggest problems that traders have when they're day trading, and see if we can't, lead you, guide you, walk beside you, help you find the way as we come in and try and figure out this crazy thing called day trading. Now, for me, what I like to do, I'm not here to tell you what to do. I'm just telling you what I like to do. All right. And so what I like to do is I like to have my stock trading account, and then I like to have my futures trading account. Now, the reason I like to trade in futures is because over in the stock market, it takes a lot of money to make a small profit. In the futures market, it's just the opposite. You can have a small amount of money make a large amount of money because of the leverage that we've got in the futures market and the lack of leverage that you've got in the stock market. Now, we can go off on branches and say, well, what about options and all that kind of stuff? But that aside, just straight up trading, we have a lot higher degree of leverage available to us in the stock market or in the futures market out of Chicago than we do out of the stock market out of New York. So if we want to have a, let's just call it what it is, a part-time job, day trading, so that we can bring in an income so that we can take that money over and put it into our long-term investments in the stock market, that's what I like to do. All right. So that's what I like to do. I like to day trade for income, and I don't do it full time. I'm not here 8 hours a day. I do it a couple hours, maybe even that, not even that, sometimes a day. And then if I make any money, any profits, I will take them out and I'll put them over into the stock market in a longer term investment strategy that's got less volatility, less risk. And so the whole situation here is that wherever you've got the possibility of making more money, like in the futures market with greater leverage, you've also got the possibility of greater loss. All right. So those two go together. Anytime you got, opportunity to make money, you've got opportunity to lose money. And if the opportunity to make the money is greater with a smaller amount of money in the futures market, that means that there's also the opportunity to lose more money than you have with a smaller amount of money. You can take a small amount of money and lose a lot of money. All right. So it goes both ways. And so the stock market takes a large amount of money to make a lot of money, but that large amount of money, when it loses, doesn't lose as much. All right. Because of the leverage again. So we have much greater degree of leverage. And yes, I know you can get leverage in the stock market, but nothing close to what you can get in the futures market. All right. It's not even close. I don't even care what you think you can get in the stock market. Oh, I can get leverage in the stock. Nothing close to what you can get in the futures market. All right. In fact, the futures market has such great leverage that they don't even have cash accounts. You can't even trade cash accounts in the futures market. You have to trade a margin account. All right. So that's the way it works. And because of that, it's a two-edged sword. You can make a lot of money, but you can also lose a lot of money. You can lose more money than you deposit. All right. So the way the futures market works is that you put up a performance bond, okay, because you're on margin. So let's say you want to buy $20,000 worth of corn. Well, you don't have to put up $20,000. Like in the stock market, if you want to buy $20,000 worth of Apple shares, you have to put up $20,000. You say, no, Lan, I've got leverage. I can put up $10,000. That's true. You can put up $10,000. You have double the leverage, 2 times leverage. Well, in the futures market, we can get upwards of 60 times, 70, 80, 90% leverage. So you might only have to put up 10 or 20% to control that entire product. So in the corn example, we may have $20,000 worth of corn, but we only have to put up $2,000. That's pretty cool. But then you make as much money as if you had the $20,000 of corn, and you never have to actually put up the $20,000 of corn because we have what we call it the futures market. Therefore, you take delivery and you make delivery. All right. But we do that sometime out in the future. Therefore, we can offset our position before we have to make or take delivery in the future, and we don't have to ever take or make delivery in the future. We can just use the leverage or the margin amount to trade off of. And that's how we as speculators come in and participate in these markets. So there's no pattern day trading rules over here in the futures market. So you can trade as many times as you want with a small account. You don't have to have that, initial $25,000 in your account to trade in the futures market. So that is one of the biggest problems that traders have when it comes to trading. They have to have a large amount of money in the stock market to make a small profit. Well, in the futures market, we just solved that problem for you. We bring you over here, and now we trade in the futures market, and we can make a large amount of money with a small investment. The only thing I'm telling you is that there is a caveat that when you have that type of leverage, you can also lose a lot of money, lose a large amount of money with a small investment. So we have to make sure that we have a risk and money management strategy under our belt before we come into the futures market and start trying to trade. And if you think you're just going to buy and hold and say, well, it's starting to lose, I'll just hang on to it until it turns and comes back, that's a formula for loss, all right? Because the market can stay irrational longer than you can stay liquid, because you're losing 60, 80, 90% value as that market goes against you because you're highly leveraged. And you can't stay in there that long, all right? You can't outweight the market like you can in the stock market. Whereas the stock market, you don't have any leverage. You're just like, well, I bought 100 shares at $10 and it's gone down to $9. I'll just sit on it until it comes back. Well, okay, you can do that, but you have no leverage in that. If you tried to do that in the futures market, you could put in your $1,000, your $10,000 investment, and the market could go down against you $20, $30, $40, $50,000 because you're only got 10% ownership of the underlying product. Does that make sense? So we don't trade like that over here. If you think you're going to come in and buy and hold in the futures market, you got another thing coming. You can't do that. All right. And to do that dollar cost average thing where it's like, well, I'll just keep buying lower and buying lower as the market goes against me. That's also another, quick way to give up your money to someone else. So when we trade in the futures market, we have to trade very close to our chest. All right. Meaning that what we have to do is we have to get our signal, get our setup. And if we're wrong, we just have to immediately get right back out. You can't stay in there and say, oh, I'm going to wait for it to come back, or, oh, I'm going to add on to my position. That's stock market stuff. And it's probably not very wise to do in the stock market either, but you have a little bit better chance of it working out for you in the stock market because you don't have the leverage and you're fully invested your entire dollar amount. Or, if you're on a margin, maybe 2%, or 50%, 1% margin, where over here you have 60, 80, 90% margin. You can't sit through it like that. So don't try. That's the point that I'm trying to make. So when we're trading in the futures market, we solve the problem. You don't need to have a whole bunch of money to make it worthwhile. You don't have to have 50, 60, 80, $100,000 to day trade with to make it worthwhile, worth sitting here doing it. All right. To make better than minimum wage. You have to have a huge amount of money in the stock market to make better than minimum wage to sit here and day trade. But not so in the futures market. With a couple grand, you can make $400, $500, $600, $800, $1,000 a day. All right. If you're a good trader, you can also lose that much in a day. All right. So you have to be careful. And so the name of the game is risk and money management. Risk and money management. You have to have a strategy underneath your belt. And that strategy is to make sure that you take your signals. And if you're not immediately right, just get out and take your loss. All right. But if you're right and the market starts to move in your favor, try and stay in strategically as long as you can to take some money so that you can build up that buffer so that when you are wrong, the winners outpay the losers. And I know we say it all the time and it sounds cliche, and a lot of, YouTube internet guys will laugh at you when you say, oh, buy low, sell high. Ha, ha, ha. No, we don't do that anymore. That's the dumbest thing in the world. That's not the dumbest thing in the world. The guy that's telling you that's the dumbest thing in the world is the dumbest guy in the world. All right. That's commandment number one when you're trading with leverage. If you're wrong, you get immediately out. All right. You don't sit there and dink around and play with this fire. This is like holding a hot coal in your hand. You can't sit there. It's going to burn a hole right through you if it's not going the right direction. Okay. So buy low, sell high, cut your losers short, let your winners run. That comes from the futures market. All right. That's the commandments, the top 2 commandments right there. And when you go over and start trading the stock market, and those kids out there, these little wet behind the ears kids, start laughing, oh, we don't do that old stuff anymore. Change the channel. Those kids are not the ones you want to be listening to. All right. You want to cut your losers short, let your winners run, buy low, sell high. All right. Now in the futures market, because we have that futures offset, we can sell high first and buy back low later. And we don't have to borrow the shares. We don't have to go out and pay interest on them. We don't have to pay dividends on them if we own them while they pay the dividend. You don't have to do any of that. It's just straight up buy it if you think it's going to go up, sell it when it gets up there, or sell it when it's up, buy it back lower when it gets down there. And that's how you make money in these markets, because you're never going to take or make delivery in the future of your corn or your wheat or your soybeans or your NASDAQ 100. All right. You're going to offset your position prior to that. Now, whether you're scalping and day trading and you're doing it in a short-term basis, or you're going to try and take a longer position in the market, you can do that too. You can position trade, what a lot of people call swing trade. Swing trade, I'm not going to get into it. It's a pet peeve of mine. Swing trading is not what everybody, that word you keep using, I don't think it means what you think it means. You ever seen that movie? Swing trading means that you buy every time you get a buy signal and you sell every time you get a sell signal. It's like going to the park and riding on a swing. You go back and forth, right? Swing trading, that's what that means. It means that if you get a buy signal, you buy. But as soon as you get a sell signal, you reverse your position and you go short, take a short position. And then if you get a buy signal, you buy again, you go long. That's swing trading. It has nothing to do with the amount of time or the size of the chart. You can swing trade on a 1-minute chart. So when these guys are out here, oh, I'm a swing trader. Bullshit. You're not a swing trader. You don't know what the hell swing trading is. You're a long-term position hold, buy and hold trader. That's what that means. When you say swing trader, I don't think that word means what you think it means. All right. So let's get our terms straight. And some yackle out there in probably some wet behind the ears kid started calling it swing trading. And so it caught on because he had a big following on YouTube or something. I don't know how that word got into the ether as being anything other than what it really is, which is buy low, sell high, sell high, buy low. That's swing trading. It has nothing to do with the amount of time you're in a market. It has to do with the strategy that you're running. All right. So keep that in mind. And we're going to go down to a smaller term time frame, and I'm going to try and solve some other problems for you too that people have when they're trading. All right, we're going to go down, and since we only have 45 minutes till the market's closing, we're not going to be doing any position trading. We're not going to hold and buy and hold for 3, 4, 5, 6 days. We're going to scalp. We're going to go in and out real fast. I'm going to show you the problems that you can solve using software. All right, software, depending on the platform you use. Now, of course, the platform I use and recommend is called Track and Trade.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so it depends on the software you have that really can help you determine whether you got tools that can help you be more successful than not. And so I like Track and Trade because we have some great tools in this software, and I'm going to show those to you. So one of the ways we're going to trade is we're going to go down to a very short-term time frame chart. And we're going to go down to a mini. We can go down to a 2-minute chart, or we can go down to a 1-minute chart. I'm going to start with the 2-minute chart. Now, I like something called Fibonacci. All right. So one of the problems that you have when you're trading is knowing how to know when the markets are going up and down. So we use these different tools that have arrows on them and that kind of stuff, right? We draw trend lines. We look for recurring price patterns. We have all that really fun stuff that we use to help us determine when we're going to get in or get out of a market. But one of the things I like to use is called Fibonacci bars. And Fibonacci bars are a smoothing component that we lay over the top of our bars to help us identify when a market's moving through a trend or not. And so you can see right now this market is not really trending. It's pretty dead right now. It's going sideways because we're getting lots of topping tails and lots of bottoming tails. For those of you who are familiar with Claire Christensen, she likes to call those fuzzy tops and fuzzy bottoms, right? Or cat whiskers. So we got lots of cat whiskers. We don't like cat whiskers, all right? We like to have flat bottoms and flat tops. So whenever a market's making lots of flat bottoms and flat tops, you know that the market's in a nice trending position, okay? Lots of flat tops along the top and lots of flat bottoms along the bottom when the market's in an uptrend. When it's in a downtrend, we want flat tops, all right? We don't want all these cat whiskers where we get lots of little topping tails and bottoming tails going both directions. That's an indecisive market when we're using Heiken Ashi bars. And so that's a real nice tool that can help you identify when that's in there. Now, I don't want to get too many indicators on here because it starts getting confusing. So I'm going to remove one. Not that they're not valuable, not that we can't use them. We certainly can. I'm just going to keep things simple here and try and help us identify some of these different trends. Now, one of the best tools, of course, is the trend line. We can just come in here when we're looking for these trends, is just to draw trend lines. And so you can see that we put a trend line underneath the market for support, and we put it above the market like this for resistance. So support is like a floor and resistance is like a ceiling. And the market likes to move between that floor and ceiling. And of course, it'll go on an angle like this or on an angle like that. And then we're going to draw our ceiling and our floor on an angle like this. All right. So then you get what we call a channel. And the market just kind of moves up through the channel. Now, I don't generally draw the other side. I don't draw both sides of the channel because it's not really all that important. What I'm mostly interested in is when a market's starting to rise, I want to see the floor. All right. And when the market's starting to fall, I want to see the ceiling. So this is where we're looking for this area of support or the area of resistance, and that's what we trade against. Now, one of my favorite tools, again, I'm not here to tell you what to do. I'm just telling you what I like to do. One of the things I like to do is I like to watch the average true range. The average true range is just basically a fancy moving average, but it tells you the average price of the market calculated by each individual price bar. And so as long as the market is trading above these little dots right here, we're in a bullish trend. As long as it's trading below it, we're in a bearish trend. And then the market is set at the average true range. Now you can see my settings. You can come in here to the ATR, and you can see that the average true range, I have a period of 1. So 1 price bar, and then the stop factor of 0.6. How far back is that going to go based on that price bar? So I'll come in here, and I'm going to come in and raise that up. And you can see as I raise that stop factor up, the dot goes farther away, meaning the average true range that we're calculating has to move farther to get above or below that dot. Now, the problem that we've got is, again, because we've got such a massive amount of leverage over here in the futures market, that little dot can be a long ways away from the market. And you can say, well, if it's above it, it's more likely to continue to climb above it. But to get above it is a lot of money. Let's draw just a dollar calculator in there. From where the market's currently trading here to that dot, $450. So if you're like, well, I'm willing to risk $450 to find out if the market's breaking above the average true range or below the average true range, well, you know, bully for you, go ahead. But to me, that's too much money. I don't want to risk that much, all right? Because we got that rule, right? Remember the rule that we talked about? Cut your losers short, let your winners run. All right. Well, $450 isn't cutting your loser short. That's letting your loser run. All right. So what I like to do is I like to come in here and be a little bit more aggressive. Now, I can't be too aggressive depending on the market, because if the market's going sideways, you can't be aggressive. But if the market's actually moving nice and with flat tops and flat bottoms, you can get very aggressive. All right. And I like to be very aggressive. So I like to wait until markets are really making nice, good, strong trends. And then I like those dots to be really tied up against those markets and be really aggressive. See, I can get down here to a 0.6 or a 0.7. 0.6 in there, and that's a nice spot where those dots are a good entry point or a reversal point or an exit point, depending on what the market's doing. The problem with that, if the market's not moving well and it's not going through with all the flat tops and flat bottoms, and you start getting lots of topping tails and bottoming tails, you get what I call spiky dikey doos, and then you're in here and you get spiked out. Okay, so the market comes in, it sends a spike up, one of those bars, and it stops you out or it gets you in just as the market turns and goes the other way, and you lose money. So that's why it's not good to trade during sideways markets with all of these cat whiskers, right? With all of these spiky dikey doos, because they come in here and they spike in and out. And you're like, well, all I'll do then is I won't have these little spiky dikey doos. I'll just loosen that up. Okay, well, loosen it up. And you can do that, but then one of the problems goes back to, well, the distance you have to put your stop so you don't get stopped out is a very large amount of money, $395. That's a big move. That's a lot of money to have to put your stop at. Now, it's going to keep you from getting spiky dikey dude out. That's true. But what if you're wrong and it goes up and stops you out anyway? Well, then you lose, basically $400 trying to avoid the spiky dikey doos. The point I'm trying to make is to avoid the spiky dikey doos, it's better just to avoid a point where they're having lots of spiky dikey doos. Don't trade then. And then that's how you avoid the spiky dikey doos, not by taking a bigger risk, but not by taking a risk at all. All right. So what we're going to do is we're going to come in and we're going to wait for the market to start making these types of moves. And then we're going to tighten up our ATR, our average true range, and bring that down. And that can help us identify where we might want to get in and get out of these markets. And I like to put that on 0.6 to start. Sometimes I'll start out at 0.1. That's my starting point, 1 and 1. But when the market starts to move like that, even 1 and 1 is a long distance away from the market. So I can tighten that down. I like to, when I'm actually trading, I like to trade it at 0.6. And that seems to be my favorite spot, right in there, 0.6. Now I'll go between price bars back and the little yellow dots. I have both, and I like to use those individually because when I'm using the Fibonacci bars, I can use those lower highs and higher lows of each individual price bar as areas of support and resistance. So I want you to think about the rule of a trend. All right, what is the definition of an uptrend? Definition of an uptrend is higher highs and higher lows. So if we get a higher high, that means this high is higher than the previous high and this low is higher than the previous low. So that would be the definition of an uptrend, right? So we got a high here, and we got a high here. Each one of those highs is higher than the previous one. We got a low here, we got a low here, but this low is higher than that one. This low is higher than that one. So that ends up what we call an uptrend. All right, now we can do that in a longer term basis. We can come down here and say, well, you've got a high here, you got a lower high here, you got a lower high here, and you got a lower high here, and you got a lower high here. Okay, well, we made our first higher low or higher high. So now we've reversed. We're no longer in a downtrend, right? So you can kind of count your downtrends and uptrends like that. And we got kind of close right here, didn't we? But it was still lower by a hair, by a whisker, right? And so we can come in and we say, well, that's the definition of an uptrend and a downtrend. Now we can also come in, and the definition of a downtrend and an uptrend can be based on individual price bars themselves. All right, not just peaks of price bar rallies and lower lows, right? Coming across here, lower lows. We can also look at that from an individual price bar. So see this price bar here, if we come in here and we blow this up real big, let's kind of expand this out so you can see these a little bit better. You can see that this high is higher than this one. Let's come over and do an uptrend because that one seems to be easier for people to understand. So we got a low here, and this low is higher than this low. 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 Therefore, what are we in? Well, we're in an uptrend. Now remember, when we're doing single bars, I'm not as concerned about the higher highs, making higher highs and higher lows. I'm mostly concerned about making higher lows. All right, it's when those higher lows stop making higher lows. Now you get into what we call pennant formations, and pennant formations are where we get these higher highs and higher lows, but then we get a higher low and we also get a lower high. So that's what we call a pennant formation. It's a little pullback where the high is lower than the previous high, but the low is higher than the previous low. So that becomes a pennant formation. All right. Some of them are a little bit more defined. And if you turn off Fibonacci, sometimes you can see them a little bit better. You get a multi-bar pennant formation. All right. But I like Fibonacci on, so we're going to work with what we've got. So that's what you're looking for. You're really looking for these higher highs and higher lows, but more importantly, again, we're more interested when we're using Fibonacci bars and we're speculating on a smaller term time frame. We're more interested in higher lows, higher lows, higher lows, higher lows. I mean, as long as that thing keeps going up, we can make money. Let's say, for example, we get in here and we get out there. Well, in this market, that would have been $1,000. And it's only what? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bars. So roughly 10 bars. That's 20 minutes because we're on a 2-minute price bar. Each one of those price bars represents 2 minutes, the open, the high, the low, and the close for 2-minute time frame. So over that 2-minute or that 20-minute time frame, that market was in a higher highs and higher lows situation, or it was in an uptrend, primarily because the lows were making continuous higher lows. So we're in an uptrend. Now we had this uptrend here, right? And then it turned and went to a little downtrend, and then it went back uptrend, a little downtrend, a little back uptrend. So, but you had on the longer term basis, like we talked about, you had higher highs, right? Higher highs on the longer term basis, and you had higher lows. So you're in an uptrend, and then it's confirmed by having well, right here we had lower highs, and then we had higher lower highs. So right, so in the longer term time frame, you can draw your little trend line across there, right? And you got your uptrend. But in the smaller time frame, in the individual price bars, we also have uptrend, downtrend, uptrend, downtrends, right? So we want to keep all that into consideration when we're trading. We want to look for nice little uptrends, nice little downtrends. We want our downtrends to always have lower highs, and we always want our uptrends to have higher lows. And when that switches, that's generally a good time to get out of the market. So see right here, this is a good time to get in the market right in here. And then this is a good time to get out of the market right here because it switched from having a bullish market, higher lows and higher lows, higher lows, higher lows, to having lower highs. And of course, the bar turned red as well. That was a little key as well. So that's kind of the nature of the beast. And you're like, oh, well, man, this ain't that hard. It's true. If a market is trending like this, it's not hard to make money. What's hard to make money is knowing when a market's going to trend like that. And when do you know a market's going to trend like that? You don't. You don't. The only way you know that a market's going to trend like that, or you think that the market might trend like that, is because it's already been trending like that. All right. If we get trends like this, a nice green up bar, and then we get a little pullback, we can anticipate, hey, we might get another nice little set of green bars again. And then we get a red bar. Oh, then we might get another little nice set of green bars again. That's called just a little wave pattern, right? So we go up, and then we get our little pullback, and we go up, and we get our little pullback, then we go up, and we get our little pullback. And so there's what we call a 3-drive pattern: drive 1, drive 2, drive 3. And that kind of reoccurring price pattern happens in the market often enough that we can trade on it and hopefully make some money. But if we're wrong, if it doesn't work out, don't sit there and say, well, I'm just going to hang on to it until it turns around and comes back. Well, how long can you sit and hang on to it and wait for it to turn around and come back? What if you said that right here? And you said, well, I'm just going to wait for it to come back. And you hung on to it. Well, you'd be down at this point $2,000 waiting for it to come back. And you're like, well, I'll just wait for it to come back some more. What it going to? Oh no, I'm going to wait for it to come back. Well, it's coming back. Okay, well, it's not coming back. It's coming back. Oh no, now I'm down another $2,500. Now I'm down $4,500. Oh no, now I'm down, $4,300. It's not coming back. How long are you going to sit on that thing and just let it bleed you dry? We too much money in these markets to sit on them when you're losing. Just don't do it. Cut your losers short. Let your winners run. All right, so this little thing's starting to go, right? We got a nice little green trend in here. Now it's already started to move. We might have missed the little bit of a run, but we can come in here and let's just say, okay, we think it's going to keep going. We'll just put one contract in and we'll just go in. So we just hit buy. Now, this is the nature of the beast. What you're going to do is you're going to come in here and immediately drop in your stop, where you're going to put it right on that yellow dot. Now, you don't have to put it on there because I'm going to show you how the software will jump it to it. But you're going to bring it in, you're going to put it right on that yellow dot, right? Now you have a stop order. Now in track and trade, we have a drag and drop application, right? It's a drag and drop software tool. So you don't have to sit there and fill in all the information in some little dialog box, and the market's already gone by the time you get your little dialog box filled and you hit enter. So this, you just drag them and drop them on the screen and you got your orders. Now you can move your orders up and down. This is how you drag your stops down. This is how you drag your stops up. You can just do it right on the screen. It's a sweet little tool, all right? Now, again, I was talking about automation. One of the greatest parts about track and trade is that you can automate some of this. So we can bring this stop order down. We can right click on it, hit edit. Now this is where you do have your little dialog box. You can come in here and you can tell it to trail. And you're going to tell it to trail on the little yellow dots, which in this case is the ATR. We're going to hit OK. Now the tool, you see it jumps all by itself. Now every time it gets a new yellow dot, it's going to jump and follow and trail up behind the market. And as long as that's ahead of it, right, it's going to make money. It's going to come up and protect your losses. And it's not going to, if it turns and flushes and goes back down, you're not going to lose $2,000, $3,000, $4,500. And as if it gets above your break-even point, well, then you can wipe the sweat off your brow and just let the market run. Cut your loser short, let your market run till it's no longer making higher lows, right? As soon as it stops making higher lows, well, you probably want to get out, take your profits. Now, if you're worried about it turning around right here, we can put another order in. It's called a limit order, which is a profit-taking order. You put that up there, and all it has to do is touch it, and that'll take your profits off. So let's say we want to take our profits right up there. If it gets up there and touches that, then we'll take our profits off. There we go. We took our profits off. Now we got our trailing stop. We have to go ahead and delete that. So we're going to kill that. And you can see we just made $190. $190, just like that. There you go. So that is how you do a little bit of day trading. Now you can do it again. You sit and wait for an opportunity and you can get in and do it again. And again, I like to make my decisions whether to get into the market where that ATR flips sides. Now, sometimes that ATR will flip a side like right here, and it doesn't go. It just goes up and then starts to go sideways, and you get a spiky dikey do and you get spiked out. But the thing you have to ask yourself was, why did I get in right there? Why did I take that arrow? Why did I take that entry? Was I getting up green higher bars prior to this one? Were there any big green bottoms, flat bottom green bars right here? No. Well, then why did you take it? I like to wait until I've already got some flat green bottoms prior to it and then say, well, I think I'm going to try and see if it's not going to make some bigger green bars, right? This one here. Little green bars, oh, we may have taken that one. Well, that might have failed on us. Well, we try it again. It's making green bars. Well, now it's making red bars. If I got some red bars and I got a red bar, I could take some red bars. But I like to see to make sure I've got some happening beforehand before I take the next run. That's just kind of a little filter I like to use. Again, I'm not telling you what to do. Just telling you what I like to do. Hold on a second. I got a drink of water. All right, so that's the nature of the beast, all right? So if you think the market's going to go, so it's making some nice green bars right here, all right? Nice little flat bottom green bars. Market's starting to turn around. We got 25 minutes before the market closes. We're rallying off the bottom here. What we could do is we say, come on, turn off those auto scales. So what we could do is we could say, well, if I get a couple little red bars in here, and then I get another green bar, I take another, because I've got green bars first, I can't take a red bar here because there's no flat bottom red bars out here, right? No flat bottom red bars out here. So I can't take a red bar. I can only take a green bar. So I have to wait until there's a set of red bars first. So I have to wait. But this is what I'll do is I'll wait until there's a little pullback. Maybe I'll get one or two red bars in here. And then when I get my first green bar, I can take another long position. Now we already took out of this one. We already took our profits. We could have stayed in longer, but I wanted to demonstrate for you how to get out and take some profits with a limit order. Now, let me show you another really cool thing. See these little QOCO buttons down here? Now, I don't expect you to understand and know how to use all these right off the bat, right out of the gate, because these are a little bit more complicated, but it's not too much more. All we're doing is telling it we want one to cancel the other or one to trigger the other. So we can come in here and we can program these. So let's say, for example, we come in here with, let's say we got our buy market, right? So we put our buy market order in there. Might not be the best time to do this, but we're going to do it anyway. We're in a demo account and I'm teaching you a lesson. Can't sit here and wait for the perfect location. But I'm going to put a stop under here and I'm going to put a limit up here, right? Now, as you saw last time, I had to when I hit the limit and took my profits, I had to automatically manually come in here and get rid of my stop, didn't I? It was still left out open. Well, there's a way to do this so that if one gets filled, the other one goes away automatically. All right. So you're long the market. This is your target to take profits. This is your target to take losses. Cut your losers short. Let your winners run. We're going to let our winner run all the way up to our limit order where we're going to take that profit. That's our target point. But I'm going to show you a neat little trick in track and trade. All right. So we come in here and we go this and we go like this. We delete this out and we're going to right click on here and we're going to say add OCO. And now you got these two are connected like this. Okay, so these two are connected. So what I'm going to do is I'm going to come in and I'm going to program this bottom one. I'm just going to drop this in here. Now I could drop it myself and just put it right on the little yellow dot, right? And every time I got a new yellow dot, I could move it. But we know we can come in and we can program that. So I can right click on there, say edit. And now we're dealing with OCO order. So I have to come down in this other box down here, not the first one like we did before. We're going to be down here. And I'm going to tell this one I'm going to trail on the ATR. So I hit OK, and that's going to jump up to the little yellow dot. Now it's going to trail up with the yellow dot. Okay, so it's going to do the same thing. And then I got this limit order up here, and I can move this up and down, whatever I want. If I want to move the stop, if I try to move that now, let's say I want to move the stop, I grab it to move it. It says, hey, I'm doing this. You program me to do it. Do you want me to take care of it, or do you want to turn me off and you do it yourself? Oh, no, I'll let you do it. So I'm going to say, do you want to continue? I say, no, you go ahead and manage that. I'll manage the limit order, and I can put that up there, and I can put that wherever I want. So I'm going to say, well, if it breaks a new high, I want to take my profits right up in here. So I can put that in there. Now I've got, if it hits my stop order, if it comes back down and stops us out and hits our stop order, well, we'll lose the difference between our entry and our stop, which is that yellow dot. And that will be our loss. And you can see our loss right here is $230. All right. So we're trailing the market behind $230. We got our limit order up here, and we got that set at $130. So if it goes up and touches our limit order, we'll take that profit off at 130, and it automatically, notice it automatically killed the stop order. That's because that was a OCO order, or one cancels other. All right. So now we don't have to clean it up. So we can just set that up, and we go off and cook eggs, or we can go to the store or whatever we want. We don't have to sit here and tend our software, because the software is going to clean that up for us automatically. And that's a nice little tool. Now, that neat little trick is all that these little buttons over here do. Each one of these little buttons, you can add them and subtract them, have as many buttons as you want. But inside of there is a little drop down where you put all of your different strategies. Now, all these strategies show up in every little drop down window, and you can assign whichever one to whichever button you want. Now, I got a whole bunch of buttons in here. You can just come in here and remove some of them so it's not so confusing, right? So now we got 3 buttons, but inside of here, all these drop downs are still there. I didn't delete the strategy. I just removed the buttons. So now I can come in and say, oh, I want another button in here. I click on that button. Now I got a new button, and I can assign any strategy to it I want. So I can come in here and I can say, I want the Minesweeper strategy assigned to button number 4. Okay. Well, if I want the Minesweeper strategy assigned to button number 1, I just come up here and go Minesweeper. Now Minesweeper's on 1 and 4. See how that works? That's pretty neat, right? So if I want to get rid of a strategy, let's say I don't want this strategy, I right click on the button, come down to modify. I want to modify, edit the existing Minesweeper strategy. Now I can just come in here and hit remove right here. And that's how you get rid of one of your strategies. All right. And then it won't be in the list anymore. So this is a really cool feature right here, being able to come in and set this all up like this. So I'm going to show you a couple of my settings in here. One of my favorites is this one here, of course, scalp market buy. Now this is just a name right in here. You just type it in there and it comes in, and you can make it say whatever you want. But I like to use kind of a shorthand of what I'm putting down here. So you can see that this is my strategy number 1. So I give it the number 1 strategy, and it's a buy market, and I'm putting the stop at 25 and the limit at 5. So this is just a real quick scalp strategy to say if the market is on a tear and it's starting to break higher, it only has to go 5 ticks and I'll take my profits off. And that's all it's doing. There's nothing else down here. There's no trailing stops or anything. That attached stop is just sitting there at 25. Actually, I've got it set up here to be trailing on the ATR. So let's go ahead and do that. We can come down here and say we're going to set our trail on the ATR. So that'll drop in at the ATR, but we'll see if it has any difference. Okay, so we're going to come in here. We're going to say okay. And now let's just say all we have to do is just hit buy, and it automatically sticks that in there. And see, it drops my stop at ATR. The ATR is going to trail in the air. The ATR is way back here. It's got a long time to move. But that limit order is only 5 ticks out. So it's going to take $25, but it's risking $135. So you got to really make sure that market's on a kind of explosive little run and going to go up. It only needs to go up 5 ticks and give you $25. Right here is we're in a drawdown already of 75 to take our 25 profit. That's probably not a very good idea. All right. Kirk wants to know if I use a jump stop. There's places where you could use a jump stop. I have a tendency to like to use trailing, but here's an example. Let's take this off the table. Let's come in here and modify this, Kirk. Let's come in here to this one, and we'll come in and we'll go to our scalp one. And let's say that what we want to do, instead of just trailing on ATR, let's come in here and let's do ticks behind. And then that's going to activate our trailing stop. We're going to do jump stop. So we're going to start, if the market moves, let's see, how am I going to do this? We're going to jump stop, attach stop. So our stop is going to be at 25. If the market moves, let's just say if the market moves 2 ticks and moves to stop plus move it to the stop, and we want to go 25 back. So we're going to go, that would move it 2 forward. So we'd go minus 23, right? So that would put us 25 ticks behind the market. So if the market jumps, if the market moves 2 ticks, if the jump stop, if the market moves 2 ticks, we're going to move to stop to break even minus 23. That would still keep us 25 behind the market because we're at 25. It moves 2 ticks, we'd move 23. And then we're going to move ticks behind. So we could come in here and we could say trail after the jump. We could trail if the market moves one. Let's see, if the market moves 1 tick, we could move 3 ticks. All right. So that would accelerate the stop into the position. Now we've only got 5 ticks. So let's raise that out a little bit. So we'll put that out at 10. So if the market moves 2, we'll jump it to 23. But then if the market moves 1 more, we'll jump 3 ticks up. How's that? That's kind of cool, right? So then we'll say, okay. Now if we come in here and we hit our little buy scalp trail on that one, so now we got the jump stop trail. So now it's going to jump up. If that market will move in our favor, it'll kind of accelerate our stop up in there. We won't be taking such a big risk on the stop. But if the market doesn't, if it just turns around and comes back against us, well, then we'll be kind of in trouble. We'll lose $135. It won't have accelerated up in there fast enough. So that's kind of a neat little trick. So that's the jump stop trail. I have it set on a few of my strategies. I don't want to say I don't use it because I do, but just not probably as prominently as I use some of the other ways. But you saw that as soon as that went up there, it broke up and above, and then that jumped up to $85 as a risk. Let's see if it'll go a little higher. Come on. So we're at 85 right now. Let's see if it'll jump. If it only has to go 1 more tick, and it'll jump 3 ticks up. Almost. There it is. Now see it jump. Now we're up. Now we're only at $70. So we accelerated our stop up. Now we're at $55. There we go. So there, see how that worked? That's kind of a neat little trick too, right there. Kirk, that was a good question. Gave us the opportunity to show you a neat little trick. So now we're up $305 positions. We had our $65 loser on that example we were talking about. But you can see how this works to come in here and take advantage of a rising market. Now notice that we have higher lows all the way up, every single one. If we would have just got right down in here and let it trail with the yellow dots and not sit here and take profits off and dink around and cruise around, we didn't know it was going to do that, right? We didn't know it was going to do that. That's why you can go in with multiple contracts. You can go in with 2 or 3 and you can sit here and dink around, take some profits off with 1 or 2, but you always let that one go. That one, this goes and goes and goes and trails the yellow dot all the way out. That's your scalp and trail. That's why we call it the scalp and trail strategy, because look, maybe once in a while you'll catch these big long moves. And if you don't have that trail on there, you won't catch the big move because you'll just keep scalping it out. So if we had gone on just with a single contract right here, we'd be up right now. Well, we'd show that we were up $1,000. But right now, because we've just been dinking around, taking one contract in and out, scalping, we're only up $300. But this is a nice trend. It just took off and went to the moon after all those little, it gave you, 3 little starts. It said, hey, I'm going to go long. I'm going to go long. And then boom, it went long, right? So it kind of tried to tell you. And that's what I like to watch for. If I'm not getting these little starts in here, I'm not going to take the trend. But I'll take the little starts. See on its downside, I'll take the downside one. If I got a red one here, but we just got all these whiskers in here. So you can come over and see like this. Okay, so you're coming in and you got this big long move. You got this little pullback. So you got the previous bunch of red bars. Well, you could take this one here. We might have missed this one here because you're going green. I'm looking for a couple pullback and then I'm waiting for the green, and the green never came till clear down here. And then at that point, you're like, oh, now I got to do reds, and then another red. And then we went sideways and just had all these little false starts. There you go. That's why you need to cut your loser short, man. When you're wrong, you got to just get out because you can't stay in and take big, huge losses. But when you're in, try and stay in. You can take your little scalps. There's nothing wrong with that. It's just that sometimes you give up if you don't try and catch that big run. So what usually ends up happening is that you take two positions, or multiples of two. So you go 2, 4, 6, 8, 10, 12, whatever. And then, you can break them up and set different quantities on different strategies. So you can say, I'm going to, go in with 6, and then 3 of them I'm going to take off on a scalp, and 3 of them I'm going to let to run. So now you're doing, a quantity of 6, 3 scalpers, 3 runners. Or you can just do 2, depending on, what your size of your account and your experience and what you want to do. You do 2, then you go, I'm gonna scalp 1, and then I'm gonna let the other one run. So what usually happens is if you have a bunch of false starts and you're doing a scalp and trail, the scalp will pay for the loss of the trail. So you won't make any money, but you won't lose as much either. It dampens the pain of having the trail not make any money on these little false starts. So if you can go in with 2, take the scalp, help you pay for the trail. If it fails, you don't lose a whole bunch of money. You do it again until you get that trailer that goes and catches that big long flat bottoms all the way up, and then that's when you make your $1,000. All right, and then you don't have a whole bunch of money to have to recover, because you're recovering it with the scalp covering the trail. The scalp covers the trail. The scalp covers the trail, and then finally you get a scalp, and it gives you the scalp money, and the trail takes off, and you go to the trail. So you have your scalp and trail. You have the money from both. And that's what I do. So again, I'm not telling you what to do. I'm just here to tell you what I do. And that's what I like to do. All right, we got 10 minutes bell coming up here. The 10-minute bell will ring in 2 minutes, 1 minute and 24 seconds. So you don't really want to be in the market at the 10-minute bell anyway, because that's when all the quant systems turn off their mathematical models, and they flatten their positions. What do you mean when you say that, Lan? Well, if I'm long and I flatten my position, if I'm long 5, I'll sell 5, and that I'm flat now. I'm not in the market anymore. Kirk says his goal is to stay in trends longer. So that's a good way to do it, Kirk. I like that idea too. I like to stay in trends longer, but I like to cover my losses when that happens. If that market comes against me, I like to have that scalper to pay for my trail, because the trail, loses money if that market doesn't go. Sometimes, though, the problem is you scalp and then it doesn't pay enough to cover the whole trail, but at least it, minimizes the losses on it. Yeah, it's a good way. I like it. It's the way I like to do it. So that's the scalp and trail. And so that's why I'll have 2 buttons over here, one for scalp and one for trail. So you can come in here and you can drop in 2 at a time. See, so you can come in here and you can go click. So, I didn't want to do that one. We'll do the other way. So we'll go click like we're going long, and that's my scalper. And then I'll come in and immediately drop my trail in underneath, and now I got a trailer. So I got a scalp and a trail. So in this case, I can scalp. Now I got my scalp that paid me $50, and now I got my trail that's going to trail on up and ride the position up. Now this one isn't. This one's looking for a reversal, but that's the idea. You get the idea. I can have a scalp and a trail. So I can have 1 button set for scalp, 1 button set for trail, and all I have to do is click 2 buttons, bang, and then bang, just like that. And so it scalps and trail, sets my position in there for me. And so now I have an entry for scalp and an entry for trail, and the scalper will take the 50, and the trail will continue higher. So it's kind of a neat little trick. All right, guys, you guys have any questions? This is a nice running market. If we had a scalp and trailed right here, we'd be up quite significantly. So this would be up, well, we'd be up right here at this point, but it would show that we were up $1,500, but our stop would be right here at 1,000, 1,100. This is a fun little market. It's taking off, going to the moon. And we're not in it. We're up $315, so can't complain about that. So I like to do a reversal strategy too. So sometimes I like to catch the reversal. So if this market's coming down, so what we can do is we can come in here and we can set up a reversal to trail with a stop order to entry. So that's what this is. Let's modify it so it's a little bit bigger. So we're going to come in here and we're going to say our stop, we're going to run a stop. So our attached stop is 20. Let's make that 25. And if I'm going to make it 25, I got to change it here. So we're going to change it up here. 25, and then we're going to have the limit. Let's put that out at let's put it out at 75. And then we're going to trail the ATR for entry, and we're going to trail the ATR for exit. We could be a little bit more aggressive, but we say I'm going to trail price bars back. I'm just going to trail one price bar back. I'll do 1.1, one price bar and one minimum move. All right, one minimum move. Where spread is right now at 2.0, so we'll have that in there for one spread. All right, you could do a 1.2, but we'll just leave it right here, 1.1, and then we're going to go okay. Now, what that's going to do is that's going to come in and it's going to catch the reversal, right? So it's going to go up and it's going to just sit there and trail up with an open stop. So it's not going to be in the market. It's going to wait until the market starts to fall. Once it starts to fall, it's going to just cross over on that little yellow dot. When it crosses that little yellow dot, actually, no, we got it set to the 1.1 bars. So it's going to trail one price bar back. So the previous price bar, which is basically the same place as that yellow dot. We could put on the yellow dot. Let's delete this one, and we'll come in here and we'll adjust it. We'll say number 2 ATR, and we're going to say instead of price bars back, we'll go ATR. So we'll go ATR entry, ATR exit, and we'll give ourselves a bigger stop. Let's put this in here at 35, and let's put this in here at 100, and we're going to come in here and we're going to say okay. And that's where you could do your risk 2-to-1 risk versus reward ratio if you wanted to. But now we're going to come in here and we're going to drop that in just like this. And you just drop it on the screen and the computer will put it in the right spot. You don't have to put it in the right spot. Did you notice when I put that on there, I'll hit exit chart again. If I want to drop that in here, I just bring it over here and drop it down here, anywhere down underneath. I don't need to go up there and try and put it right in the right spot because I'll probably get it in the wrong spot. And the computer will go, what are you doing? You're putting it in the wrong spot. So then you come down here and you just drop it down here and you say, oh, you put it in the spot you want it then. And it'll put it right up there where it wants it. Now it's going to sit there with an open trailing stop. So see that? This order is open. That's why the little triangle is open. This triangle is open. This triangle is open. But because it's one, they're all connected together. This is the primary order. It has to be filled before these orders become active. So these are called ghost orders. And then this one is your primary order. And it's called an OTO order. One triggers other. So once our primary order here, which is our stop, our trailing ATR stop gets triggered, these will become active. Right now, they're not active. They're just ghosts. And so they'll sit there, but as soon as that one becomes active, these become active, and then that'll act as our stop, and it'll trail on the ATR. This will act as our limit, and it'll take a position or take profits as the market falls in our favor. And in the meantime, it's just going to sit there and trail up on that yellow dot. All right. Waiting for the market to reverse, and we're going to catch that reversal coming back down. Now, this is where you can get aggressive with your ATR. You can come in here and you say, well, I want it to be closer. I want it to be right up there tight. Okay, well, bring that ATR in tighter like this. Next time you get a new bar, it'll jump a little closer. So we'll put it on 0.5 instead of 0.6. As soon as we get a new bar, it'll jump it right up there close. Come on, give us a new bar. Show us that example. Oh, we got 1 minute and 3 seconds because we're on 2-minute bars, not 1-minute bars. So we have to wait. Boy, this market's going. It's going to the moon. NASDAQ's up 100. That's good. Let's look at our real money portfolio and see how we're doing today. Can't complain, I guess. Not the greatest today. We're only up about $1,000. Can't complain about that. All right. So we're just letting it go. Look at it go. Holy cow, this market. This is going to catch a reversal. All right. This is going to catch the reversal. So if it falls, we get a new bar here in 10 seconds and watch what this thing does. It's going to jump to the yellow dots. 4, 3, 2, 1. Get a new bar. Look at it jump. See that? Jumped all the way up to that last yellow dot. Right? I'm sitting here pointing at the screen as if you can see my finger. See that? Now if it reverses and comes back down, oh, it filled our order and then went back up. So we got spiky dikey dude because we held our stop too close. Look at that. Right there. We got spiked in it. Little spiky dikey do. Touched our order and then went up and hit our stop. And we lost $170. we're down to $145. That's a dirty trick. I hate it when that happens. We took our little ATR too close. Let's bring it back out a little bit. We'll do price bars. Well, 6 is about 1 price bar back. So we're going to take and drop our same little tool in here, catch the next reversal. We'll try again. This time, since we'll do 2. We did 1 last time. We got stopped out with a loss. Now we're going to do 2. Look for the reversal here in the last minute. What do we got before the market closes? We got 3 minutes before the market closes. Are we going to get any order filled at all? Well, actually, we can go into the after hours. Now, remember, in the stock market, you have after hours. Once you go into the after hours in the stock market, you're limited to, you can only use limit orders. You can't use stop order. You can't use all these fancy OCO orders and stuff. Futures market, you can. We got an after hours, and we got another hour after this, so we could go into after hours trading. Now, of course, the market starts to go really badly sideways. I wouldn't recommend you try it during that time frame. But you can trade during that after hours time frame, and then the orders in the futures market, you can still use your stops and your limits and your OCOs and your OTOs and your market orders, and you can use all the orders. They don't restrict you. This is the last bastion of true capitalism on earth today. That's what we call it, right? Come on, baby. Let's get a reversal on here as we go in. It'll be a good example to see us get a nice reversal and have the market flush down. You can see where we'd get in if it started to fall. It would drop right here on this little yellow dot, the crossing of the yellow dot. Good thing we got out when we did, though. I mean, it came down, spiky dikey dooed us out because we were holding our stops too close, our stop entry, our limit order too close. Hit our yellow dot and then turned and started to go back up again. Good thing we did, because if we were holding on to it saying, well, I'm just going to hang on to it, we'd be down, instead of 170, we'd be down 375. Just keeps going and going. Market can stay irrational longer than you can stay liquid. All right, so we're waiting for the reversal. Now you can be a little bit more aggressive. We're on the yellow dot here. Now we got too aggressive when we got stopped out, but you could still be a little bit more aggressive if you want to. We can come in here. This market's going to close here in 42 seconds. 40 seconds, the market's going to close. But we could come in here and let's say exit this, and we could just say, I'm going to take this one here, and I'm going to put a stop right here. If it breaks that low, we break a new low, you could take it 2 shorts right off that breaking of that action bar is the one I call it. I call that the action bar. What a beautiful run. Holy cow. We should have just been straight up scalping and trailing. Oh, well, we got to learn. This is a lesson class. This is a lesson class. Look at it go. Wow. That's beautiful. Makes you wish you were trading real money, doesn't it? Look at that baby go. Okay, we can move this up again. Try and catch the reversal. Here we are. We got the previous high. So it's coming up. It's going to test that previous high. It did. Touched it right there, didn't it? Now the question is, it going to break above it and hold above it? It's going to do that in the after hours because the market just closed. A lot of guys will take a short right there. We'll see what happens. We're going to wait for the reversal, though. We want lower highs and lower lows. Look at that whole trend. We had higher lows all the way up that whole trend. Right there, we got right where we were starting to play around. We got that one little spiky dikey do right there. Look at it still trying to go. Well, we're in the after hours now. Market's closed. Of course, the market doesn't actually close here in the futures market for another hour. But because the stock market closed, that's where a lot of the volume and open interest is. So kind of losing its strength right now. I'd like to see us get a reversal on here just to show you how that open stop works, but I'm not getting it. All right, I got something fun to show you. A lot of you guys come and hang out with me a little bit more often than some of the others. Some of you guys know Claire. She's been crazy the last couple of days. She published the magazine. So the magazine, Pit News Magazine, went out, and hopefully you got your issue. The most recent issue went out the other day, so she's had a few minutes to play around, and she sent these over. They're kind of funny. They're little AI things. All right, I think AI is kind of a fun little. It's a fun little thing. I love AI. Oh, we got a new bar. Let's move this up. Now we're doing this manually. You could program it to do it yourself, just to go up one bar back, but we're going to go closer. We're going to go to the action bar. So Claire's been playing with the AI system. She sent this over. She sent this over of Aiden. She made this one. That's funny. And then she made another one of herself. I'll show you the one of her after this one. So watch this one first.
The other day I was sitting at my trading desk here in Sedona. The sun coming up over the red rocks. My betta fish, I named Delta, was floating perfectly still, as if he was watching the screen over my shoulder. I had a synthetic long position on, and it was finally paying off, up double digits. I sat there staring at the numbers, wondering if I should just take the money and run, or hang on a little longer and hope for more. The classic trader's dilemma. While I was thinking it over, my phone buzzed. It was Claire. She wrote, "Riley says you should cash out before you jinx it. Riley's her cat." I rolled my eyes and texted back, "Tell Riley I'll cash out when he can explain gamma risk to me. That's the kind of thing I write about every month for Pit News Magazine." The daily struggle is real, even for someone like me, who's been at this for over a decade. If you want to read more about what trading really feels like and maybe pick up a few tips along the way, check out pitnews.com and subscribe. We're all just trying to make the right call, one trade at a time.
I thought that was funny. She sent that over last night. She goes, "Here, play this in your class tomorrow." And then she gave me one of herself. So here's one she made of herself. Check this one out.
Okay, quick question. Are you subscribed to Pit News Magazine yet? No? Really? Then what are you even doing with your life? Here's the deal. Pit News on air is like the espresso shot. Quick, a little chaotic, and probably too much of me. But Pit News Magazine? That's the full latte with oat milk, cinnamon, and that fancy latte art you pretend not to care about. Subscribe to Pit News Magazine at pitnews.com. Because if you like hearing me panic about Fibonacci levels, wait until you read what the pros are actually writing. And don't forget to follow my weekly podcast, Pit News on Air, where we take the best of the magazine and bring it straight into your ears. Do it now. Seriously. Because if you don't, Mr. Turner says I have to come to your house and personally explain options trading, and nobody wants that.
Yeah, nobody wants that. Nobody wants Claire to come to your house. How could a cartoon be so sexy? See, that's a sexy little cartoon she sent over. Oh my gosh. I'm like, I don't think I can play that, Claire. She goes, "Why? It's YouTube. It's not church." Okay. It's not church. Okay, there you go. Unless you want Claire coming over to your house, you better subscribe to Pit News Magazine over at pitnews.com. That'll keep people from subscribing, Claire. I don't think people would mind if you came over to their house and explained options to them. All right, we haven't got an intercept here yet. I'm trying to get one intercept just to right there. Come on, intercept us. Reversal and intercept. And then we'll drop another one in the other side. It's just being real slow right now. Got to break that low. Of course, that's the action bar. So it could break the low and still stay higher. It's just that I'm being real super aggressive. We should really just have it one price bar back right here so we get lower lows, right? But I was trying to get a feel here. But I'm just not getting one. Still getting higher lows. Crazy, man, this market. That's a nice little pennant, though. Look at that little pennant right there. Oh, that didn't draw a pennant. Where's your pennant tool, Lan? Right here. There's your little pennant. You're going to break out the top of the pennant or break out the bottom? You could bracket it. You could come in here and you say, I'm going to put one on a break above. If it continues to go higher, I'm going to get in long. If it goes lower, I'm going to get in short. And you could bracket and you could do that with these little tools down here too. You could bracket the market. I don't really want to get in long though. Don't want to bracket way up there. All right, guys, we run out of time. I got to let you go. I'll give you one more little AI system here. One more. We're playing with AI. This one's one of my favorites right here.
Come on, folks. Look, the only thing I regret about my presidency is that I didn't subscribe to Pitt News Magazine. Don't make the same mistake I made.
All right. Don't make the same mistake. All right. Subscribe to Pitt News Magazine. All right, guys. We will catch you tomorrow morning, 8 a.m. We're going to go back into our software application, our new software. I'm going to show you some new tools on rebalancing your portfolio. So take your profits out of here, and we're going to take them over to the stock market, and we're going to put them into some pretty aggressive funds over there. So come and play with us, and we're going to do that tomorrow morning, bright and early, 8 o'clock a.m. Mountain Standard Time. Make the adjustment for your time frame, and we'll see you tomorrow morning. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.